right, welcome to Iron Financial. We're the only channel out there dedicated to putting the market's biggest names on the anvil, stress testing them so you can forge a stronger portfolio. I'm your lead analyst. Today, we are hammering on the German tech giant SAP. Now, their Q1 numbers just dropped, and man, the headlines looked powerful. We're talking cloud revenue just rocketing up 27%, profits up 24%. And you know the market, it just ate it up at first. But our job here, as always, is to look past those shiny headlines, and that's where I come in. I'm the market skeptic. My job is to find the hairline fractures, the cracks in the armor. You know, that impressive facade might look like solid steel from a distance, but is it hiding a foundation built on sand? Is SAP really forging this indestructible AI empire they keep talking about? Or is this just another flashy growth story that's about to buckle under some real pressure? Well, that's what we're here to find out. So here's the blueprint for today's stress test. First, we're going to forge the bull case. Really examine the raw power behind those Q1 numbers. Then, we're going to pop the hood and inspect the machinery of their cloud growth engine and break down their big AI master plan. But after that, well, that's when the skeptic's hammer comes out. We're going to hunt for cracks in the armor, we'll assess the geopolitical storm clouds that are brewing on the horizon, and then, finally, we'll deliver the iron verdict. Let's get to work. Okay, if you're going to build the bull case, you have to start with the heaviest, most solid materials you can find. And for SAP, that's these top-line numbers from Q1 that really got everyone's attention. These stats paint a picture of a company that is absolutely operating from a position of undeniable strength. It looks like they're firing on all cylinders. This, right here, is the foundation of the entire bull thesis. Just look at this. Really look at the sheer force behind this number. 27% growth in cloud revenue. You gotta understand, this isn't some minor uptick. This is the primary engine of the entire company just roaring to life. We're talking nearly 6 billion euros in a single quarter. This is the absolute powerhouse driving the entire structure forward. It's exactly this kind of explosive, undeniable momentum that the bulls are seizing on to build their entire thesis. And honestly, it's what makes SAP a real contender right now, not just some dusty old legacy player. Okay, so that's the current power. Now let's talk about the foundation for their future earnings. What you're looking at here is a 21.9 billion euro current cloud backlog. Let me be clear about what this is. This isn't revenue they hope to get. No, this is contracted, signed, committed business that's already in the pipeline, and it's up a massive 25% year over year. Think of this as the steel framework for the skyscraper they're trying to build. It gives you incredible visibility into future quarters and tells you that Q1's insane growth wasn't just a fluke. It is structurally supported for the foreseeable future, and that should insulate them from at least some short-term market turbulence. But here's the billion-dollar question, or in this case, the multi-billion euro question. Is all this growth actually profitable? And the answer is a resounding yes. A 24% increase in their non-IFRS operating profit, hitting 2.9 billion euros. This proves that the machine isn't just big, it's efficient. They are not just out there chasing revenue at any cost. No, this growth is translating directly to the bottom line where it counts. This is where the rubber meets the road, folks. It demonstrates disciplined execution, real operational leverage, and it tells me this is a company that's firmly in control of its own destiny. So, we've seen the powerful headlines. They're impressive, no doubt about it. But now it's time to get out the schematics. We need to take a much deeper look at the individual components of this cloud growth engine. We've got to understand precisely where all this power is coming from. Is it broad-based and durable, or is it concentrated and maybe a little fragile? Let's drill down into the details. Okay, let's break this down piece by piece. This table really shows that the engine isn't just running, it is outperforming in the ways that matter most. Sure, the overall 27% cloud revenue growth is impressive as a headline, but look at the core. Look at the cloud ERP suite. That's the software for managing a company's absolute most critical functions. We're talking finance, supply chain, HR, the works. That piece is up a massive 30%. This is the very heart of their business, and seeing their central pillar showing accelerated strength like this, that's a sign of a very, very healthy and powerful core. Now, this is a critical point. You have to understand, they aren't just riding some big market wave that's lifting all boats. No way. According to brand new Gartner research, while the entire enterprise cloud market grew somewhere around 10%, SAP's cloud business surged by 25%. You heard me right, they grew 15 percentage points faster than the competition. This isn't growth by default. This is a strategic land grab. They are actively going out and taking territory from their rivals like Oracle, proving that their offerings are winning in the trenches. They're not just maintaining their moat, they're actively building it wider. And who exactly is buying into all this? Just look at this roster. It's a who's who of industrial titans. You've got ConocoPhillips in energy, Thylase in defense, Bristol-Myers Squibb in biotech, PayPal in fintech. These are not speculative startups playing with venture capital money. These are mission-critical, global industries operating in highly regulated sectors, and they are betting their core operations on SAP's cloud platform. This demonstrates a really broad-based, resilient demand that isn't just dependent on one single hot sector. This is the real deal. So the present is strong. The foundation looks solid. We've established that. But for any portfolio to really grow, you need to be invested in the future. So now we need to inspect SAP's AI master plan, because this is where they're laying the foundation for what they hope will be the next decade of dominance. This is all about building the next floor of the empire. Now, I need you to pay very close attention to the distinction they're making here. This is so important. SAP isn't trying to build some generic consumer-facing chatbot to compete with the likes of Google or OpenAI. They are building business AI. This is industrial-grade artificial intelligence, and it's built on a 50-year bedrock of proprietary enterprise data that nobody else has. It's an AI that deeply understands things like payroll, complex supply chains, and quarterly financial closes. It is designed from the ground up for reliability and security, not just for having a clever conversation. And right here is the blueprint, straight from CEO Christian Klein. It's a very logical three-step assault on the market. First, leverage their most unique asset, that institutional brain of data. Again, no one else has it. Second, use AI as a catalyst, as a tool to accelerate migration to their cloud platform, making the switch easier and faster. And third, govern the entire system with enterprise-grade security and accuracy. This is precisely what a CFO or COO needs to hear before they even think about letting an AI touch their financials. This isn't just defensible, it's a fortress. And here you have it. The CEO is laying it all out himself. He believes their unique assets, the deep process know-how, the absolutely invaluable data, and the enterprise-grade trust they've built over decades give them an almost insurmountable head start in the race for business AI. He is making a very powerful argument for long-term, durable dominance. It's a compelling vision, you have to admit. A compelling vision indeed, and you've built a very impressive structure, I'll give you that. But you know what they say, a structure is only as strong as its weakest point. So now, it's time to take out the hammer. It's my turn to stress test this entire narrative and see if we can find the cracks in the armor. Because every single investor out there needs to know what could potentially bring this whole fortress down. So I am going to ask the one question that every smart investor in our audience is probably thinking right now. That was a great story, a really great story. But is it sustainable? Is this growth engine really built for the long haul? Or is it just burning fuel way too fast and hiding some serious structural flaws underneath all of that polish? It's time to dig a little deeper, don't you think? And the very first crack appears right here, plain as day in their own revenue statement. While everyone is out celebrating the 27% cloud growth, you have to look at the other side of the ledger. Software licenses, their old, super high-margin cash cow, are down a brutal 33%. Services revenue is also shrinking, down 6%. So the question is painfully simple. Are they building the new skyscraper fast enough to offset the controlled demolition of their old buildings? That is a massive, massive hole to fill, and it seems to be getting deeper every quarter. And hey, don't just take my word for it. Listen to the company's own chief financial officer, Dominic Assam. In the earnings call, he explicitly guided for a slight deceleration. His words, not mine. A deceleration in both the cloud backlog and cloud revenue growth. He is literally telling the market that the incredible pace we saw in Q1 is not the new normal. So any bull out there who thinks this 27% growth is some new sustainable trend needs to ask a very serious question. Are we looking at the beginning of a powerful ramp, or did we just witness the peak? Now let's really dig into the quality of that so-called impressive profit beat. A huge chunk of it, 135 million euros to be exact, came from a decline in share-based compensation expenses. And why did that happen? Oh, because SAP's share price tanked 28% during the quarter. The CFO himself on the call called this an unintended relief. So I have to ask, is this profit growth really the result of true operational excellence, or is it a financial anomaly? A lucky break they got from their own stock performing poorly. That, my friends, is not what I would call a high-quality beat. So, okay, we found some potential fractures inside the company's own financials. Now, let's look outside. Let's talk about the massive storm clouds that are gathering on the horizon. A risk that management didn't just mention in passing. No, they repeatedly flagged it as a major, major threat to their global operations. This quote from the CFO should send an absolute chill down any investor's spine. It is impossible to reasonably quantify the impact of such a meltdown scenario. And he's talking specifically about an escalation of the conflict in the Middle East. These are not the carefully chosen, reassuring words of a confident executive. This is a frank admission that there is a massive, unquantifiable external risk that could absolutely derail global supply chains and, by extension, their entire business model. This is the very definition of a black swan event lurking in plain sight. And for me, this right here might be the most critical blow to the entire bull case. The CFO stated, on the record, that SAP will, quote, need that contribution from recent acquisitions just to hit their existing full-year guidance. Just let that sink in for a second. Their organic business, the very engine that everyone is so excited about, may not be strong enough on its own to meet their own forecast. They are actively relying on acquired revenue just to plug a hole. That tells me there is absolutely zero margin for error here, and it strongly suggests the organic business is weaker than it appears on the surface.
All right, we've done the work. We've laid out the bull case, the whole story of a powerful machine firing on all cylinders. And we've taken the skeptic's hammer to it, exposing the cracks, the risks, and the external pressures. So now it's time to bring it all together and deliver the iron verdict. Is SAP an opportunity to forge some real durable gains, or is it a cleverly disguised trap for the unwary investor?
Let's put it all on the scales. On one side, you have the forge, the bull case. It's built on the undeniable power of dominant cloud growth, a massive steel-reinforced backlog, and a very clear strategic plan to win in business AI. But on the other side, the anvil, the bear case, it strikes back hard with the CFO's own warnings of decelerating momentum, collapsing legacy revenues, an unquantifiable geopolitical storm, and a pretty worrying dependence on acquisitions just to make the numbers look good.
So, after all that, what is the iron verdict? Our analysis concludes that SAP is a forge under pressure. The fundamental machinery is incredibly strong. You simply cannot deny the power of their cloud engine and their dominant market position. However, that strength is being severely, and I mean severely, tested by visible internal cracks and some very powerful external headwinds. This is absolutely not a set-and-forget stock you just buy and ignore for 5 years. This is a high-stakes bet on flawless execution in an increasingly volatile world. And that leaves the final question for you, our audience. We've shown you all the forces at play, the undeniable strength and the serious stress. Now you have to ask yourself, is your portfolio forged with the kind of strength that's required to withstand this level of pressure? We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.